Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, April 17th. Hope you guys having a wonderful day so far. We'll jump right into it. Again, we got a lot of data to go over. Monday through Thursday, we got quite a bit of data. So today is no different. So we had housing starts for the month of March. So previous month, we had 1.295 in February. Forecast was supposed to go up a little bit, or actually dip down a little bit to 1.255, and it actually went upwards to 1.319. Now, this looks great. Unfortunately, the disappointing part of it is the bulk of this housing start is multifamily. So this is great for a rental market, but not so much for those who wish to buy a brand new home. So it doesn't really help out the real estate market as much. Building permits, I think that's pretty much the same thing. We had 1.321 in the month of February, and it went up to 1.354. So on the headline, looks great. Unfortunately, again, multi-families are making the bulk of these on there. So I guess what they're trying to do is cover their butt, so to speak, in terms of the market ever turns. Therefore, it's balanced out from multifamilies versus single families. They're not sitting on a bunch of stock of single family homes there. Now we got a couple other ones here. We got industrial production for the month of March. So in February it was up 0.9%. For the month of cash for March it was 0.4, and it exceeded that to 0.5%. And then last but not least, we got capacity utilization. So we had a 77.7 in month of February, and it was supposed to come in at 78 for March, and it came in at forecast at 78, which is obviously very good news there as well. So overall, not bad here. It's just unfortunately housing starts and building permits is a little misleading, and it doesn't really help out the real estate market as much as we would like it to. We still got a lot of demand, and unfortunately, there's just not enough supply to meet that demand as of yet. Right now, the stock market is up. We're still coming out with Q1 2018 earnings reports, which have been coming out very well. They've been very pleased with so far with what we had. The first day was kind of a little shaky as they seemed to have probably too high expectations, but even though the data came in well and it was down. Also today came in China released their Q1. Their Q1 numbers, the economy grew was at 6.8%, which is still good pace there. Comments were made about how the tariffs and talking about the trade war hasn't really done much for them, but when you got to think about it, it only started in March, which is obviously the last month and probably a few weeks into it. So I personally wouldn't expect to see much that in Q1 for their reporting. So we'd have to kind of wait to see Q2, see if there's much done. And I don't know how much actually this was implemented or if it's just talk so far. We got later today, we got some Fed speakers speaking today. There's a lot of arrangements going on throughout the world. We got one that's John Williams from San Francisco. He's speaking in Madrid, Spain. We got other speakers around the country here. And of course, anything that they say could potentially rattle the markets a little bit, especially if they're talking about raising rates more than the three, for the year, and anything with inflation talk that could potentially put the water to the fire, so to speak. Here's the bond market. We are still below this 25-day moving average. We're pretty close to where we left off yesterday, which we rebounded from starting way down here, all the way up here, closing as a positive. And right now we're down about 3 to 5 basis points right now so far this morning. So not enough to change pricing, but those who started pricing up lower here may not have given any price improvements, and therefore you may see that price improvement today. So most likely you could be seeing some improvement today as a result for the later rebound in the bond market, as the morning was down a bit. Treasury, there's this kind of help putting a cap on that. So what's nice about this is that it's been testing this 50-day moving average. It hasn't been able to go above it. We're still at about 2.83 right now in terms of where we are on the 10-year Treasury. And with the 50-day moving average keeping it down, it may be helping us keep a cap on how much further it's falling on the mortgage-backed securities. So if this breaks above the 50-day moving average, this could push bond market even further down their ladder and thus raising interest rates. So if this 50-day moving average can hold and maybe even push the yields down further, it could help out mortgage rates and help us break back above that 25 and 50-day moving average as well. So that pretty much wraps things up. You may see some improvement in rates, but if you look at the charts itself, there's no difference in pricing. But again, a lot of people price earlier in the day. We kind of that later rebound, and therefore a lot of lenders will probably have a little better pricing today as a result of that. So if you guys want to get more data, just come over to Twitter. You can find me at Mike Bjork on Twitter and follow me there and get your scoop of the day during there. All right, you guys have a great rest of your day. Thanks so much for watching. We look forward to see you guys tomorrow. Bye-bye.